Jagdishwar Gattu is also joining us today for this conference. Uh, so I'll start with the business performance for the quarter. This quarter was definitely a very strong quarter across all dimensions of performance. Our revenues grew 1% sequentially and 3.4% year on year in constant currency. Our services revenue grew 1.6% sequentially and 3.4% year on year, again on constant currency. One of the big highlights of the quarter is our operating margins. We recorded an 18.5% operating margin, which is a 154 basis points improvement at the company level, and at the services level, the margins improved by 212 basis points. This margin improvement is primarily through driving efficiencies in our managed services engagement through automation and AI ops capabilities. We also significantly reduced our dependence on subcontractors. We used our own employees to replace subcontractors. And we also controlled some of the discretionary spend like travel and other costs during the quarter, which eventually has delivered an exceptional margin performance. Another very big highlight for this quarter is our bookings in this quarter is at an all-time high. And for your reference, the booking numbers that we share is the TCV of the net new deals. It does not include rate card deals. It does not include renewals. All of that is not included. These are new contracts signed with customers. It's at an all-time high at $4 billion. This is a 154% growth from a quarter-on-quarter perspective and a 67% growth on a year-on-year basis. To get into some more details of our quarterly performance, our service revenue, IT and business services grew 4.6% on a year-on-year basis and 0.9% from a quarter-on-quarter perspective on a constant currency basis. Our engineering services delivered a very strong growth of 5% sequentially on a constant currency basis, including the ASAP acquisition that concluded on 31st of August. HCL software continues to grow well. They continue to deliver 3% plus ARR growth. From an overall revenue perspective, 3.6% year-on-year growth in constant currency in our HCL software business. Four of the verticals grew very well. Our retail CPG vertical grew 7.5% quarter-on-quarter, followed by telecom and media, which we had highlighted last quarter that it was weak, but this quarter telecom and media vertical has grown 6.2% quarter-on-quarter, which is again a fantastic performance. These are really attributed to very good execution of the deals that we won in the previous quarters, which is really translating to revenue. We continue to have a strong run in our financial services and our life sciences verticals, which all reported good growth, both sequentially and year-on-year perspective. In terms of geographies, our growth markets, which is really the markets outside Americas and Europe, which is really our Asia-Pac, Japan, Middle East, and India market, delivered a growth of 6.1% on a sequential basis. And Americas and Europe both grew about 3.9% on a year-on-year basis, all in constant currency. Our attrition continues to trend down. It's at 14.2% on a quarter-on-quarter basis. It's a 2.1% drop, and it is the lowest that we have experienced since the first quarter of FY24. Our employee count decreased by 1% on a sequential basis because we have consciously not backfilled some attrition, because a lot of freshers whom we hired in the last 18 months, they've got trained, they've really become quite experienced in the client engagement, so we have largely backfilled our attrition through the freshers. I have another very happy news to share on an ESG front. EcoVadis has rated HCLTech as a gold category. We are placed in the 94th percentile for our advanced sustainability performance. During this quarter, we also launched HCLTech grants in Americas for the climate action. We've committed about $5 million over 5 years. This program will provide grants to NGOs uh, combating climate change and restoring ecosystems and biodiversity across Americas, which is our largest market. 64% of our revenue comes from there. Now, looking ahead, the next 2 quarters, we expect a very healthy sequential organic growth in our services business. This growth in normal times would have been considered extremely good because it includes a seasonally weak Q3 in the services business. However, for the entire year, when combined with the weak Q1, which we reported last quarter, and a good Q2 that we are reporting today, our overall growth will add up to 4.5 to 5.5% organic growth for services for fiscal 24. We won some very large deals and we've been successful in gaining share on both cost optimization deals and transformation deals. However, the market is still a little tepid on the discretionary spend. At the start of the year, we expected the discretionary spend would start coming back, partially at least, but with the continuing macros, spending has not come back the way we expected. So, from this perspective, our revenue guidance for the full year, including the contribution from ASAP acquisition and the HCL software business, we will end up in the range of 5 to 6% growth at the company level in this fiscal year, of course, on a constant currency basis. Our operating margins, we are confident to deliver within the stated guidance of 18 to 19%. And with that, I will request Pratik to cover some more details on our financials.
Thank you, CVK. I'll give you some numbers in rupees because that's the country we are all based out of. The HCLTech revenue for the quarter came in at 26,672 crores, which is a 8% year-on-year growth. What CVK was talking about was constant currency and dollar terms. The rupee terms is 8%. HCL software was up 8.1% and services at 24,169 crores was up 8% year-on-year as well. Sequentially, on a Q-on-Q basis, it was up 2%. Within that, IT and business services grew at 9.5% year-on-year, and ERS grew at 1.7% year-on-year. ERS obviously went through a couple of tough quarters, but has shown a healthy organic growth, 1.6%, including ASAP 5% sequentially. EBITDA margin for the quarter was at 22.3%, which is an increase of 30 basis points year-on-year. And in rupee terms, it's up 9.6% year-on-year. EBIT margin is 18.5, which is 50 basis points above the 18% we had in September quarter last year. And in rupee terms, it's 11.5% growth. And net income profit after tax is a growth of 9.8% versus the same quarter last year. In percentage of revenue terms, it's at 14.4%, which is an increase of 20 basis points over last year. Our return on invested capital, ROIC, has improved quite notably due to our continuous focus on profitability and very proactively managing the capital efficiency. So the last 12 months ROIC stands at 32.2% for the company, which is up 350 basis points, 3.5 percentage points on a year-on-year basis. And within that, services is at ROIC of 39.4%, almost touching 40% now. And software at 16.2%. This was a quarter of exceptionally good cash generation, and on a LTM basis also it continues to demonstrate very healthy cash conversion. Operating cash flow came in at 10,800 crores and free cash flow at 10,231 crores for H1, being 147% of profit after tax and 139% of profit after tax, respectively. Our balance sheet remains very strong with gross cash of $2.85 billion and net cash at $2.56 billion. And this cash generation was made possible because we reduced our DSO by 5 full days, and on a sequential basis, quarter on quarter, and year on year, it was a reduction by 6 days. So that has enabled the cash conversion. For our shareholders, the last 12 months, diluted EPS amounts to close to 57 rupees, 56.95 to be precise, which is an increase of 11.8% year on year and 2.3% sequentially. And the board has declared a dividend of 12 rupees for the quarter, up from the 10 rupees pace that we were following for the last 2 years. And now it is 12 rupees for the quarter. And the record date of which will be 20th October, which is next Friday. And the payment date will be 31st of October. And this 12 rupees, so on a last 12-month basis, it will become 50 rupees, which is a payout ratio of 88% versus the 57 rupees of EPS, which is aligned with our capital payout run. So with that, I'll hand over to Jags for some comments on the digital foundation.
Thank you, Pratik, and hello, everyone. Looking at the DFS business, we're delivering market-leading performance. And also, if I look at the pipeline, we're showing the strong pipeline also. While customers are looking for cost optimization, they want to achieve this cost optimization through tech transformation as well as they're relooking at this IT strategy, how we want to achieve. If I look at double-click a little bit of the DFS business, we are seeing growth in cloud and networks and next generation networks and also cybersecurity. If I see the cloud, now customers are relooking at this cloud adoption and migration strategy primarily from purpose-based cloud or more pragmatic approach. Our cloud smart portfolio will help them to achieve that particular purpose. Whereas if I take the network, next generation network services, there are two trends we're seeing. One is the enterprises want to transform their network, primarily looking at on the back of the edge development and hybrid development. And on the another track, telecom providers, they wanted to basically partner with providers like us and then deliver the best value for their end customers. And you have seen the example of Verizon in the last what we have announced. And if I take the cybersecurity as a service line, based on what is happening around the globe, there is enterprises definitely assigning a lot more budgets allocation to security, and we're seeing quite a good headroom in that particular area. As far as the cost is concerned, we're delivering already excellent world-class services powered by automation as well as our DryAce platform and infused by the generative AI. And we definitely see that it is a good from a cost structure perspective, as well as the quality of services and experience from a customer point of view. So overall, net, when I see this is a good traction to grow the services revenues. On that note, I'm going to hand over to Ram.
Thank you, Jack. Good evening, everybody. I'll just add a couple of more details to what CVK has already called out. The people strength for this quarter closing is a 1% drop. It's 221,139. We did add 3,630 freshers. We broadly will be in line with our quarterly plan for the year. We closed the year with about 10,000 freshers addition for this year. Attrition, again, at 14.2%. It's one of the best years. about 2.1% lower than last quarter. More importantly, if we look at the attrition now, it's pretty much pre-COVID levels. So you can say that we have been through the journey of spike in attrition and are now down to the pre-COVID levels. So that's one of the highlights. Last quarter, we took a decision to defer the pay reviews by 1 quarter. So we will be going ahead with pay revisions this quarter effective October. So the decision that we took last time that our mid-managers and senior managers will not have a pay review this year, we will defer the cycle. That decision to skip the cycle for the mid and senior management remains. But for 90% of our employees, we will go ahead with the pay revision effective this month. So that's going to be part of this quarter's exercise. I'll just pause there. If there are any questions on any of the people-related stuff, we can pick that up in the Q&A session.
सर मेरा नाम अनुवेश रात है, मैं जी बिज़नेस से हूँ। सर पिछले क्वार्टर को अगर देखा जाए और इस क्वार्टर को भी देखा जाए तो आपका जो नेट एडिशन है नए लोगों को रिक्रूट करने का वो दोनों बार कम रहा है। आगे चलते हुए इस पूरे साल में आप कितना रिक्रूट करने चाहेंगे और ये जो कम हुआ है उसका रीज़न क्या था? दूसरा सवाल ये है कि आपका जो मैन्युफैक्चरिंग सेगमेंट है उसमें जो ग्रोथ है वो थोड़ा कम दिखता है, तो उसको आगे चलते हुए आप किस तरीके से सुधारने की प्रक्रिया में हैं?
Do you want me to take the headcount question? Yeah. Okay. I'm going to respond in English. I can speak Hindi, but maybe not as fluent, so I'll respond in English. It's true that the AMJ quarter and JAS quarter, there's been a 1% drop in headcount. So there are two ways to look at what's happening, right? One, last year, we added about 27,000 freshers. That's one of the highest fresher intake that we have had in the previous 4 years. So we've made a lot of investment in getting freshers added to the organization, and there's a lead time by when the freshers turn productive and billing starts. So that's one reason. The other reason that CVK called out is there's also a lot of focus on efficiency improvement within the organization. So that's those are the two reasons why you see the headcount drop the way it is. Going forward in terms of headcount, every quarter we just moderate our intake based on a number of things. Demand is one part of it. Attrition is also another significant part of it. So that's the reason I called out the attrition. It's the lowest in now almost 4 years. It's effectively the pre-COVID level. So, which is good news. If the attrition drops, it gives us a lot of stability. We don't need to spend too much time and effort trying to recruit. So those are the reasons why our headcount moves the way it moves. It's largely down to fresher addition and efficiencies.
Thank you, Ram. I can also speak in Hindi, but I want all of you to stay in the room. So I won't do that. So manufacturing vertical declined primarily because in some of the projects we have certain assets or materials like computers and equipments which are part of the projects. And if you see that component of the revenue has decreased, if you see our detailed P&L, it has decreased by about 25 million. And some of that is in the manufacturing segment. But if you look at the pure services, it continues to remain a healthy vertical for us. Thank you.
Hello. Hi, Saurav from Business Standard. Good evening. I would like to ask you, this is a big, there is a big revision in your revenue growth guidance for this year. What is the reason? Do you see pipeline conversion not happening at the speed you were expecting last quarter? And the other question is, if you minus the Verizon deal that you won, what is the scenario in telecom and tech vertical? Are you seeing the recovery that you were expecting?
Yeah. So if you see this quarter, as I announced, the telecom, media and entertainment segment has grown sequentially 6.2%, which is a very, very strong growth. This is, we have no contribution from the strategic partnership that we have announced in Verizon, which is going to come from 1st of November as we had announced. So our telecom business is going to grow really very, very strongly in this year. So we think that's really a extraordinary performance on the telecom segment. And your first question was on the overall guidance. If you really look at our performance in Q1, our revenue had declined. Q2 is 1% growth. Now, for the guidance that we have given, we need to still grow quite strongly in H2, including a very strong sequential growth in Q3, and on top of it, another good sequential growth in Q4. So really, the rest of the year is going to be very strong. And the reason for revising the guidance was first half has been much lesser than what we expected. So we have to build on top of it, and that is the reason we've guided. And given the guidance of 4 to 5% organic growth and 4.5 to 5.5% services growth, we will be delivering one of the highest growth in the industry, even in this uncertain macro environments.
Yeah, maybe I can just add. So, simple answer is it's really mathematics. Half the year is already over. Nobody can change that. At the revised guidance that we are giving, mathematics simple says 3 to 4% CQGR. So 3 to 4% in the next quarter and 3 to 4% in the next quarter. That is what will get us to the guidance. And that is what CVK mentioned in his opening comments is a very attractive growth in any normal time also, and certainly in these times.
Yeah.
Hi, sir. My name is Danish Anand. I'm from CNBC TV 18. Sir, as far as your deal wins are concerned, when do you really feel that they will contribute to the growth? And what is your overall outlook on the second half?
Yeah. So basically, it's the same response. Second half is we expect it to be very strong. As we mentioned, the strategic partnership with Verizon, which is one of the largest deals that we signed, the revenue will start flowing from 1st of November. And even in addition to Verizon, we are going to see a good growth in Q3 and Q4. Even though Q3 is a seasonally weak quarter, some of the ramp-ups that we have done will help us achieve pretty strong growth. As Prateek said, 3 to 4% is the number that we are looking at in Q3 and Q4. So I think our second half is going to be very strong.
Hi.
We can hear you, but if you could be louder.
Hi, Annapurna here from ET. Could you talk a bit about what has the client demand sentiment been like? Do you think they'll continue to spend on large deals like we've seen? And about your campus placement plans, Infosys is not going for them, so what is your approach going to be? And if you could, I think you mentioned the numbers of the freshers onboarded. Could you please repeat the numbers on the onboarded freshers, and what is the number of freshers onboarded this fiscal so far?
Yeah. I'll answer the business question, and Ram can follow it up with the responses on the people front. I mean, client spend is really focused on what we call a zero-cost transformation, which means they want us to take over a certain scope, make it much more efficient, and whatever savings that they get from that, they want to reinvest in transformation. Right? That is a broad theme. Even though a lot of deals, industry is talking about cost optimization deals, it is not just a pure play cost optimization. It is really you bring in a certain level of transformation which really takes out cost. That is the kind of spend pattern that we are looking at. And Ram can answer the rest of the questions.
Sure. Hi. Freshers, this fiscal we have added about 5,200. Last quarter we reported about 1,600. This quarter about 3,630. Usually the JAS quarter has a higher intake. We'll close the year at about 10,000. Right. So whatever we did in H1, we'll do equivalent numbers in H2. So it'll be about 10,000. In terms of campus programs and visit to campus, we continue the program. There's no change in plan. As we speak, my colleagues are all active visiting campuses. So that program continues. There's no change to that program. I hope I'm audible. If I'm not audible, somebody needs to. Yeah.
Sorry.
Hi, what is the impact of the war in West Asia right now, and how many people do you have at the moment in Israel?
It's a very small number, 100 plus people maybe. There's no business impact at this point.
Yeah, if there are no more questions, we'll move to yeah.
Are you seeing any pricing pressure due to the macroeconomic conditions?
That's a very generic question, but I think it all depends on very situational. It's very situational. I would say, I mean, with whatever we have seen, pricing has been stable.
Okay, if no more questions, I'll pass it on to Siddharth to connect us to people who've joined us virtually. Siddharth, over to you.
Thank you, Ashutosh. Ladies and gentlemen, in case you are on the computer system and want to ask a question, please click on the raise hand icon and we will unmute your line. The first question for today we have from Setu Raman from Reuters. Setu, please go ahead.
Gentlemen, just wanted to check. So the deal flow has been like pretty strong, but on the other hand, like I understand that you mentioned that the first half was softer than expected, but the guidance cut is also like pretty strong, right? Like so from 6 to 8%, 4 to 5%. So I just want to know, is this basically reflecting the uncertain situation that is going on for all your peers? That is my first question. And like, at what point do you expect to see double-digit revenue growth? So that is my second question. And also, I also want to know. So you mentioned that the deals were like sort of net new that you had given. So these are like long-term ones, or like I understand Verizon is a long-term one. So I also want to know like how is the deal environment looking for you? Like, is it more of a short-term deals or one-off long-term deals of sort of that kind? And final question is, how do you have you witnessed any ramp downs or project cancellations that you signed during the pandemic period? Because so you had one large number of deals during pandemic. All of them were digital transformation. A lot of your peers have been saying that there have been ramp downs and discretionary spending cuts. So these are some of mine. Thank you.
Yeah, Setu, I'm just hoping that I'll remember all your questions, but let me start with the first one. First one, you talked about the bookings and all that, and why is the guidance reduced? As we said, it's really a first half problem. First half has been overall soft, and the second half, as we highlighted and Pratik also highlighted, we expect a very strong second half. And when we talk about guidance, it does factor in all the aspects. The discretionary spend, as I mentioned, is still very soft. We have not seen the discretionary spend pick up like we anticipated. But the bookings that we have done in the last quarter and even the prior quarter, some of them will convert into revenue. And that followed by the large deal execution, we will deliver a solid growth in Q3 and Q4. Then your next question was...
when is the double digit?
Yeah, double digit growth is right now we are very focused on financial year 24, for which we have given a total guidance of 5 to 6%. So I think generally the environment is quite volatile, so it's very difficult to take a call from a long-term perspective. We are very focused on executing this financial year, and in April, we'll give you a perspective of what the growth after that is going to be.
There was one on deal tenure.
Yeah, deal tenure is, I think we have a $4 billion of booking. As you called out, Verizon is a strategic partnership. It's a 6-year term. But all others deals you can classify into two categories. One is long-term deals. I think our maximum deal is 5 years is the tenure of the deal, and the rest of the deals that we've signed. And every quarter we also sign a number of small deals. Small deals it adds up to some decent number. These are smaller projects. They're typically maybe less than 2 years kind of tenure. Thank you.
Thank you. Our next question is from the line of Anisha from ET Now. Anisha, please go ahead.
Organic growth in the ER&T segment, and I beg your pardon if you mentioned it already, but just wanted to get that number. And the other question, CVK, is on the deal pipeline. Yes, the conversion this time has been very strong at $4 billion, but is that the run rate we should envisage going forward? Prateek, a question for you on the win rates and the pricing, how both of them are panning out. Would you go ahead and say that you are increasing your market share in any way? And lastly, Aparav, a question to you, more of a clarification. Did you say that you're going to add 10,000 freshers in this year?
Yeah, so let me start. I think your first question was the organic growth in ERS. So overall growth is 5% sequential, and organic growth is 1.6% in engineering services. And Ram, you can answer the other questions.
Okay, so I am Ram.
Change from Appa. There was one more question.
Yeah, so freshers, yes, for this year, you have got it right. We'll be targeting 10,000.
And Anisha, on your question, I mean, we didn't get the line very clear, especially at the beginning, but your question on the pricing, we already mentioned that it remains stable, so it is not, and you had the other question about, is the 4 billion going to be sustained? We would love it to be, but we are certainly not guiding. Our run rate for the last almost 2-3 years has been 2 to 2.5 kind of a range. That would be more realistic to pencil in, but we would love it if it is 4 every quarter.
And just to clarify that even a 2 billion or 2.5 billion run rate is all net new deals, net new firm contracts. It is not any rate card or any kind of framework kind of contract. These are firm contracts that we have.
Even,
good.
Even for the renewals that we have, we take only the incremental TCV to give you this number.
Okay, thank you, gentlemen. And let me apologize, Ram. It's just the muscle memory to call out Aparav's name.
Yeah, that's fine.
Appreciate.
That's okay. That's okay.
And
That's
just
fine.
one question, since you talked about the renewal rate as well, Prateek. How have the renewals been? I mean, of course, the win rate for the fresh new deal win is strong at 4 billion. What about renewals?
Actually, renewals has been very strong this quarter. We don't call out the renewal TCV, but pretty much all the deals that have come up for renewal where signatures have happened, we've concluded in our favor. Okay. There are more? Okay.
Hello, am I audible?
Yeah, the next question is from Prasun from PTI. Prasun, please go ahead.
Hi, my question to me when you spoke about salary revision part. If you can repeat that, and in addition to that, I have a question. Have you seen any trend of clients shifting their employees on HCL payrolls when they are outsourcing you some deal? These are two questions for Mr. Ramachandran, and then I have follow-up questions with the panel.
Okay. You're calling out my name. I lost what your first question is. I'll first address the second question.
So better to call him Appa only.
Okay. So the pay revision, So last quarter, we said we took two decisions. One, we said our middle managers and senior managers will skip the pay revision cycle this year. That decision stays. The second decision that we took is for the rest of our colleagues, we will review it in this quarter, which is a decision that we have taken, that we will go ahead with the pay revision. And that's effectively covering 90% of our employees. Right, so that's about the pay. Outsourcing deals, are there employees who will transfer over from client organizations to HCLTech? Yes. Some of the large outsourcing contracts, we will have what we call as employee rebadging. It happens, and we'll continue to do that.
And that is not a new trend. It's always been there. Last 20 years, we've seen some clients transfer some of the employees as a part of the outsourcing deals. Thank you.
Have you seen any change in the trend in terms of geographies from where most of the employees are coming onto your payrolls?
I wouldn't say there's any change in that trend. It happens largely across all three major markets for us. US, Europe, and parts of Asia Pacific will continue to see that. That's been the trend, and that's what we continue to see. I don't see any change in that.
I'm not sure where your questions are coming from, but just to keep in mind that it is important for the continuity of the quality of the project and the work. It is good that employees that were doing the work earlier get transferred to us. And of course, we will make it better and transform, and all the digital transformation that Jag spoke about is what we are best known for.
Thank you. The next question is from the line of Shavik Das from Mint. Shavik, please go ahead.
Hi, gentlemen. Just wanted to understand the overall generative AI landscape. Is that translating to business, and is that translating to quantifiable revenue for HCL? And also, when it comes to fresher hiring, are you seeing enough onboarding of projects to warrant new hires, or would you also look at utilizing your bench?
Yes, on generative AI, there is quite a strong traction. Pretty much in every client conversation, we discuss about how generative AI can help the current execution, as well as a lot of new ideas on how it can help our clients improve the quality of service, reduce their cost, efficiency, all of that. So today we have over 100 opportunities that we are working on, but most of them are proof of concepts. They are sub $500,000, sub $1 million type of opportunities. And this quarter we've called out two things for one of the very large software majors. We've been selected as a partner to leverage generative AI in their product testing and sustenance efforts. We're trying to deploy generative AI through a private language model to improve the resolution rates and speed, efficiency, all of that. We are also, we signed with the bank to use generative AI to improve their risk and compliance efforts, which is a very, very big effort in a lot of financial services firms. So we are already seeing deals getting signed, but it is as expected in any new technology, it always starts with a proof of concept, and then it will scale over a period of time. But we continue to see tremendous traction on this front in the market.
We have one last question from Devangana from Money Control. Devangana, please go ahead.
Hello, gentlemen. So I just have one question. So your operating margins have improved a lot this quarter. So just wanted to get an understanding, is this the level that you're expecting to continue in the upcoming quarters as well? And also, what levers do you have in place to drive that kind of an improvement?
Yeah. So, Devangana, our guidance for the year stays at the same 18 to 19%. So that's the number for the year. So we were lower in the first quarter. We've made it up in the second, and we'll sort of stay at these kind of levels is what we expect. to be in the 18 to 19 range that we already talked about.
No more questions online.
Yeah, yeah,
Over to
yeah.
you, Ashutosh.
This one, last one is one for Ram and probably one for you, CVK. What is the variable payout for the quarter? Is for Ram, and for CVK, can you please give some color on the market sentiment in Europe and North America?
So I think quarterly variable pay, I think we first need to put some context to it. In terms of the overall compensation package, the quarterly variable pay is 3% of the annual compensation of the individual. It's not a big portion, right? So this quarter will continue with our quarterly variable pay. So all our colleagues will get their quarterly variable pay this quarter. Majority of them should see their quarterly variable pay to be upwards of 85%.
Yeah, in terms of market sentiment, of course, it's generally reflected in two metrics. One is the booking and the second one is pipeline. So bookings, as you saw, it's been an all-time high. And if you look at the pipeline last quarter, if you recall, I said our pipeline is really at the highest levels. It's come down a little bit because this quarter we had some good bookings, but it is still very close to the peak kind of pipelines. And that is quite representative in US and in Europe. So we don't see one or other having a stronger or weaker demand. Our pipeline is in line with our revenue proportion. So generally, the most of the deals are driven by efficiency-led opportunities, but efficiency does not come just by labor arbitrage kind of solutions. You need to use technology. You need to use leverage automation, AI ops, all the technologies that we have, and the platforms that we have to deliver high quality service at a much more efficient kind of operating levers. So that's really the predominant theme in the trends in the market. Yeah. So with that, thank you everyone for joining us and really appreciate your time. Have a good evening.
Thank you.
Thank you.
Thank you.
Thank you.
What looks good to you on the chart?